Hi friends. Welcome back. In this video we are going to discuss about EBITDA. Following are the topics covered in this video to understand EBITDA. The first one is, what is EBITDA? Next one, how to calculate EBITDA? Then, what is Warren Buffett's thoughts on EBITDA? With examples. Then, what percent of EBITDA is good for an organization? What is negative EBITDA? Then, how to calculate EBITDA margin? And finally examples. Let's start. What is EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. EBITDA used to measures the company's overall financial performance. EBITDA, also used to understand how the core business of the company is performing as such. Earnings is nothing but net income. This signifies the income that the company has generated after taking care of all the expenses. Before excludes certain item from operational metric. Interest is excluded depends on your financial structure. Taxes are excluded depends on your geography that you operate. Depreciation and amortization are excluded based on the investment decision. The next one is how to calculate EBITDA? There are two approaches. One, top-down approach, and the another one is bottom-up approach. In both the approach, outcome would be the same. First we'll see bottom-up approach. Here is the sample finance sheet of an organization. If you see the sales of the organization as $10,000, and the net profit is $900. In the bottom-up approach, here is the formula, EBITDA equals net income, which is nothing but earnings, plus interest, plus taxes, plus depreciation, plus amortization. In this example, the net income is $900, now add tax $500, and add the interest $1,000, finally add depreciation and amortization, which is $500 plus 100, total $600. Now the EBITDA is $3,000. This is the core earning of the business. This excludes operational expenses. Let's see the top-down approach. It is fairly simple. Start from the top. EBITDA equals 2. Sales minus COGS, cost of goods sold, minus SGA, selling general and admin expenses. Now the EBITDA is $3,000. If you see outcome of both the approach, it gives same value, which is $3,000. However, bottom-up approach is the commonly used approach across the industry. I hope you have got some fair idea about the EBITDA calculation. Alright. Let's see, what percent of EBITDA is good for an organization? Is 28% EBITDA good? Generally, the higher the EBITDA margin, the greater the profitability and efficiency of a company. Gold monitors the EBITDA margin at each of Popham's London sites. He tells us that a good EBITDA margin for each site is 25% to 40%, depending on the type of operation. Let's see how to calculate EBITDA margin. To calculate EBITDA margin, divide company's earnings before interest, taxes, depreciation, and amortization with the revenue. The formula is EBITDA divided by its total revenue, and then multiply by 100 to express it as a percentage. In this example, $3,000 divided by revenue, which is sales, multiple by 100 equals 30%. 30% is the good EBITDA margin as per industry standard. Let's see what Warren Buffett states. Warren Buffett shares some of his thoughts on EBITDA. It amazes me how widespread the use of EBITDA has become. People try to dress up financial statements with it. We won't buy into companies where someone's talking about EBITDA. If you look at all companies, and split them into companies that use EBITDA as a metric and those that don't, I suspect you'll find a lot more fraud in the former group. Look at companies like Walmart, GE and Microsoft, they'll never use EBITDA in their annual report. The Tooth Fairy pays for capital expenditures? Warren Buffett is credited with having said, "Does management think the Tooth Fairy pays for capital expenditures?" EBITDA is used to analyze and compare the profitability between different companies in the same industry as it eliminates financing effects and accounting decisions. Many times, a company changes the items included in their EBITDA metric calculation from one reporting period to the next. Because of this, Warren Buffett does not think that it is a true representation of the company's performance financially. In other words, Mr. Buffett is pointing at the fault of using EBITDA metrics in that they exclude depreciation and amortization as a means of valuing the company. Although the depreciation and amortization expense is not an actual cash outflow, it does, in effect, reduce the value of a company's total assets through reducing the value of specific capital and/or financial assets. This reduction in value is intended to closely mimic the true nature and value of the asset. As an example, imagine a company that has no other assets other than multiple factories under its property, plant, and equipment asset account. Naturally, over time, these factories would lose value as they age and are used up. Using EBITDA as a means of valuing this company would be entirely fallacious, as it would not account for the loss in value that the factories are experiencing. Using EBITDA, in this case, would overstate the company's earnings, and thus, overstate their value. Look at this example. Organization A gives the EBITDA of $3,000 and Organization B gives the EBITDA of $2,500. Note the EBITDA margin is 30% and 25% respectively. Now the Organization B EBITDA looks like 25%, which is good for an organization as per the standard, but the net income reflects negatively, which is minus $500. This could be one of the reasons sometime it does not gives right picture. Negative EBITDA. This happens when a company's cash and cash equivalents exceed its market capitalization plus debt. It's rare, but can occur in cash-rich companies with low market valuations. Negative EBITDA. This indicates the company is losing money at the operational level. Alright, hope you have got some fair idea about EBITDA. Please share your comments and suggestion for improvement. Share it with your friends and knowledge seekers. At last, thanks for watching. EBITDA, also used to understand how the core business of the company is performing as such. Earnings is nothing but net income. This signifies the income that the company has generated after taking care of all the expenses. Before excludes certain item from operational metric. Interest is excluded depends on your financial structure. Taxes are excluded depends on your geography that you operate. Depreciation and amortization are excluded based on the investment decision. Generally, the higher the EBITDA margin, the greater the profitability and efficiency of a company. Gold monitors the EBITDA margin at each of Popham's London sites. He tells us that a good EBITDA margin for each site is 25% to 40%, depending on the type of operation. Negative EBITDA. This happens when a company's cash and cash equivalents exceed its market capitalization plus debt. It's rare, but can occur in cash-rich companies with low market valuations. Negative EBITDA. This indicates the company is losing money at the operational level.